Dear friends in the United States, serious investors are constantly seeking ways to survive and grow through every phase of the market cycle. Today, I would like to begin with a truth that I have witnessed over more than 50 years of observing Wall Street and crowd behavior. For a very long time, I have heard the familiar phrase repeated countless times: cash is trash. The loudest voices are often the last to go bankrupt when the music stops, when the market cycle shifts into recession and everything collapses. They mock caution. They call holding cash lazy or short-sighted. Yet history has proven the opposite. It is not the most intellectually brilliant investor who survives. It is the one who still has cash on hand when panic strikes. This is the core principle of the method that I developed and applied throughout my life. The market is not a straight line that rises forever. It operates in clear and recurring cycles that repeat across decades: the accumulation phase, the markup phase, the distribution phase, and the markdown phase. When the public is intoxicated during the markup phase, when prices climb rapidly and the belief that this time is different spreads everywhere, many investors commit all of their capital to the market. They borrow additional funds. They go all in because they fear missing out. They fail to recognize that during the distribution phase, when the composite man is quietly selling, they are buying near the top. Then the markdown phase begins. Prices fall sharply. Liquidity disappears. Only then do they realize they have no cash left and no room to maneuver. What remains are regrets and losses that cannot easily be repaired. From my perspective, cash is not trash. It is a weapon. It allows you to stand aside safely during the distribution and markdown phases. It prevents you from being swept away by crowd mania. It preserves your composure. Most importantly, it prepares you to enter the next accumulation phase with full resources. When large operators begin accumulating again at lower price levels, when the market forms a bottom and early signs of reversal appear, those who still hold cash are able to act decisively and purchase genuine value. I have seen this pattern repeat many times. 1929, 1973 to 1974, 2008, and many other cycles. Those who ridicule cash during periods of euphoria are often the first to beg for liquidity when everything collapses. Meanwhile, those who maintain cash reserves wait patiently. They become the final buyers. They help determine value instead of being forced to accept whatever price the market imposes. Therefore, at the beginning of this talk, I want you to internalize one principle: cash is not a burden. It is a shield that protects you from the folly of the crowd. It is the foundation that allows you to survive the markdown phase. It is the key that enables you to capitalize on the next accumulation phase. If you understand this, you already possess half of the power of the Wyckoff method. The remaining half is patience, and we will explore that in greater depth shortly. Every investor likes to talk about opportunity. They imagine buying at extremely attractive prices during market panic, when stock prices decline sharply and fear dominates Wall Street. Many even quote the famous advice to buy when there is blood in the streets. However, after decades of observation, I have recognized a harsh reality when that moment truly arrives, when genuine panic takes hold. Most of them no longer have cash available to act. What remains are empty theories and lingering regret. The mistake lies in their approach to the market. During periods of rapid price appreciation, they deploy all available capital. Some even borrow additional funds to chase the crowd. At that time, the composite man who controls supply and demand is quietly distributing shares near the top. The crowd, fueled by enthusiasm, believes the market can only move higher. They exhaust their cash to participate. As a result, when the sharp decline begins, when liquidity dries up and investors rush to sell, they have completely lost the ability to act. They dream of great opportunities, yet they fail to prepare for them. Holding a significant cash reserve is not a sign of laziness or a lack of ambition. It is one of the most intelligent and conservative position management techniques within capital allocation strategy. Holding cash means deliberately stepping aside from the late stage of an advance and reserving resources for genuine opportunity when the market enters a new accumulation phase. This is the most prudent way to survive long enough through volatility and to build a solid foundation for sustainable wealth over time. Whether you manage billions of dollars for clients or operate a personal investment account, there is one invincible rule: never allow yourself to run out of cash when the world loses its composure. When fear spreads, cash becomes the most valuable asset. It not only protects you from severe losses, but also grants you real power. It gives you the ability to act calmly while others are forced into retreat. Investors who appear talented on paper yet go bankrupt in reality often ignore this simple principle. Those who understand the power of cash quietly maintain strong positions and transform the crowd's fear into their own strategic advantage. That is why position management is never merely about buying or selling stocks. It is also about knowing when to remain still and hold cash so that you not only survive, but truly dominate the next market cycle. To help you better understand the consequences of failing to maintain cash reserves, let me describe a representative example involving one of the most respected financial institutions in the United States. The Harvard Endowment Fund allocated nearly all of the capital under its management to the market when prices were at their peak. It did not stop at the core endowment assets. It also invested prepaid student tuition funds aggressively. Confident that its team of experts and sophisticated analytical models made it superior to the market, the fund deployed almost its entire liquidity position. When the market reversed and entered a severe markdown phase, the fund endured significant pain for 2 to 3 years. Performance declined sharply. Board meetings turned into sessions of accountability marked by regret. The institution was forced to reduce important programs and faced strong criticism from donors. This case clearly demonstrates what happens when intelligence is guided by arrogance. The market does not care where you graduated, how many degrees you hold, or how advanced your analytical tools may be. It waits patiently for the moment when you run out of cash. Once the composite man completes distribution at elevated price levels and drives the market into markdown, even the most powerful institutions become fragile and helpless due to insufficient liquidity. All intelligent calculations on paper dissolve under the undeniable force of supply and demand cycles. From the perspective of the Wyckoff method, the lesson is profound and principled. We must never speculate with our own essential funds. We must never risk the lifetime savings of millions of Americans who entrust their capital to us. When managing capital for others, whether in a large fund or a personal account, defensive positioning is not excessive caution. It is a basic ethical responsibility and the only viable survival strategy. Only by prioritizing capital preservation and survival can you truly act effectively when a new accumulation phase begins. Arrogance is the most dangerous enemy of any investor. The market is the arena where arrogance is punished without mercy. That is why I consistently emphasize this principle: defense is not passivity. It is the only way to maintain a strong position and remain prepared to dominate the next market cycle. Now, let us examine more deeply the true power of holding cash. It is not merely a number on a balance sheet. It is the source of decisive advantage when markets descend into disorder. When the markdown phase intensifies, when stock prices fall rapidly and fear spreads across Wall Street, most participants suddenly begin to pray for liquidity. They ask banks for additional credit. They hope clients will not withdraw capital. They wish the market would pause so they can breathe. I do not pray for liquidity. I prepare it in advance. That is the fundamental difference between an active participant and a reactive participant in the market cycle. Cash provides the most valuable asset during such moments: time. Time to think clearly. Time to reassess conditions without emotional pressure. While others panic and make rushed decisions driven by fear or fragile hope, you retain the space to evaluate objectively. You can ask which high-quality assets are being oversold, which fundamentally strong companies are significantly mispriced. Your judgment becomes sharper because it is not diluted by the fear of total loss. Furthermore, when others are frozen, meaning they cannot raise additional capital, cannot liquidate assets without severe losses, and cannot think coherently due to margin calls or negative cash flow, you are able to act swiftly and decisively. With cash available, you do not require permission from anyone. You can initiate purchases immediately. You may even acquire an entire company while others are still calculating their losses and attempting to salvage what remains. I have observed this repeatedly across multiple cycles. Investors who appear intelligent on paper but lack liquidity often become victims. They are forced to liquidate strong assets at the lowest prices simply to survive. In contrast, those who maintain cash reserves become the final buyers. They influence valuation rather than accept prices imposed by the market. This is not random luck. It is the result of systematic preparation and a clear understanding that during panic, liquidity is true power. Therefore, when constructing your own investment strategy, always remember that cash does more than protect you from loss. It grants you control over time. control over judgment, control over action when others have lost control of themselves. This is the advantage consistently utilized by the composite man. It is also the advantage available to any serious investor who maintains disciplined liquidity management. Truly transformative opportunities, the kind that can completely reshape a portfolio, do not appear frequently. From decades of observing market cycles, I can state with confidence that over a span of 20 to 30 years of investing, most of us encounter only 2 or 3 moments of exceptional significance. These are the periods when valuation distortions become extreme, when the composite man begins aggressive accumulation near the bottom, and when the market is preparing to enter a new markup phase. Your primary task is not to capture every minor rally or chase every short-term signal. Your task is to hold a large bucket rather than a small cup. Most investors make a fatal mistake. During favorable market years, they exhaust their cash to purchase whatever Wall Street offers. They fear missing small daily gains, so they commit all available capital and often apply leverage to increase exposure. When the rare moment of extraordinary opportunity finally arrives, when high-quality assets are liquidated at unprecedented discounts, they no longer possess the capacity to act. Cash is a powerful option on future opportunity. It is a license to act decisively and at scale when a clear reversal signal emerges. At that moment, you are not purchasing a few hundred shares. You are deploying capital in substantial size. You may even acquire an entire enterprise while others are still calculating losses and attempting to salvage what remains. Whether the signal originates in New York, London, or Berlin, you can respond immediately without forced liquidation or external approval. This is the true strength of a liquidity position within the Wyckoff method. You do not need to predict exact dates. You need only remain prepared so that when a rare opportunity appears, you become the final buyer, the participant who influences valuation rather than being constrained by it. Many investors in the United States fail because they do not understand that patient cash reserves are not wasteful. They are the only practical way to capture life-changing moments. Once you grasp this principle, you begin to view markets differently. You stop chasing minor fluctuations. You wait calmly for substantial shifts. Preparation becomes strategic advantage. Many observers look at my decision to maintain cash reserves and label it boring, patience, inactivity, or even sluggishness. Some dismiss it as outdated investing. I am not concerned. That apparent boredom forms the foundation of durable wealth. In contrast, what appears dramatic and exciting, such as aggressive chasing of rising prices, concentrated all in decisions and rapid success stories promoted by the media, often ends in insolvency when the market cycle reverses. Allow me to clarify this distinction. If I were managing only my personal capital, I might be more relaxed. I could choose a simple strategy such as investing in a broad market index fund and allowing time to compound returns. However, when managing other people's capital, lifetime savings, retirement funds, and the accumulated resources of millions of American families, I do not have the authority to take that level of risk. In that case, I must construct a fortress, strong walls, a deep and wide moat, excess cash reserves to defend the entire structure. This is not excessive conservatism. It is ethical responsibility and strategic necessity. Once you lose other people's capital, you lose more than money. You lose trust, and trust is far more difficult to rebuild. Cash, in this context, does not arise from pessimism or constant disaster forecasting. It arises from a simple reality. Markets inevitably experience unexpected phases and shocks that no one can forecast with precision. Consider a commercial airline pilot. The aircraft does not require reserve altitude during normal conditions. Yet when an engine fails, when severe weather emerges unexpectedly, or when a system malfunction occurs, reserve altitude becomes life-saving. In that moment, you are grateful the aircraft was not flying close to the ground merely to conserve fuel. In investing, cash serves as your reserve altitude. You do not need to deploy it daily. It does not compound continuously like equities or fixed income securities. However, when systems break down, when the markdown phase intensifies, when liquidity disappears, and when margin calls escalate, cash prevents a free fall. It allows you to maintain positions, avoid forced liquidation of quality assets at distressed prices, and most importantly, avoid permanent impairment of capital, the type of risk that can erase years of accumulation within months. When constructing a long-term investment strategy, consider the objective carefully. Do you wish to appear intelligent during speculative expansions, or do you intend to achieve durable wealth and security across decades? Patient discipline is not the final objective. It is the mechanism that enables survival across cycles and the ability to seize rare opportunities that truly alter financial outcomes. That is how the composite man operates. Quietly, patiently, always prepared when the moment arrives. One of the greatest enemies of an investor is not a bear market. It is the psychology within each individual. I have witnessed thousands of instances of a rapidly spreading condition within the American investment community: fear of missing out. When markets accelerate upward, when friends, colleagues, and social media participants display substantial gains, many investors suddenly feel left behind. They begin to think, if I do not enter now, I will miss the opportunity of a lifetime. At that point, rational thinking stops. Objective analysis stops. Adherence to a disciplined plan stops. They commit all available capital. Some even borrow additional funds to chase upward momentum. This is the most dangerous condition I have observed. Fear of missing out does more than push you to purchase at elevated prices. It causes you to forget a fundamental principle: unrealized gains cannot be spent. During euphoric conditions, everything appears favorable. Prices rise continuously. Account balances expand. A sense of invincibility spreads. Yet when the tide reverses, when the markdown phase truly begins, reality becomes clear. Either you hold actual cash or you hold actual losses. Paper profits disappear faster than most expect. If liquidity has already been exhausted in pursuit of rising prices, there is nothing left to provide protection. This is where cash exerts its greatest psychological strength. It creates valuable emotional distance between you and collective panic. While others are selling aggressively, reacting to fear, and responding to urgent calls for immediate action, you can remain composed. You can ignore media noise, social pressure, and emotional commentary. You can calmly ask the critical question that most participants forget: which assets are genuinely undervalued and which high-quality securities are being liquidated below intrinsic value. Such emotional distance cannot exist if you are excessively leveraged or completely illiquid. When margin calls intensify, when forced liquidation occurs, and when the fear of total loss dominates your thoughts, clarity disappears. You become controlled by emotion rather than by judgment. In contrast, when you maintain cash reserves, you preserve composure. This composure is consistently maintained by the composite man throughout all phases of the cycle. You are not swept into crowd hysteria. You are not pressured to act merely to avoid feeling excluded. You retain the ability to choose to wait longer, to analyze more deeply, or to deploy capital only when signals become clear and decisive. In today's investment environment, filled with rapid success narratives and constant calls to act, the ability to remain still and mentally disciplined is a decisive competitive advantage. Cash is not merely a balance sheet figure. It functions as protection against fear of missing out. It shields your judgment from decisions that may cause permanent damage. When you maintain emotional distance, you no longer chase the market. You allow the market to approach you. This is how you not only survive, but position yourself to lead over long-term cycles. Now consider cash from a different perspective. It is not merely a defensive shield. It is the sharpest weapon an investor can possess when the market shifts from panic to opportunity. Cash does not generate immediate returns like equities or fixed income securities during an expansion. For that reason, many describe it as a dead asset. I take the opposite view. Panic is what truly becomes expensive. When investors are forced to liquidate strong assets, to repay debt, to meet margin calls, or simply because they cannot endure psychological pressure, they pay with substantial losses and permanently missed opportunities. In that environment, cash is flexible capital. It is not inactive. It is waiting for optimal deployment. When the markdown phase reaches its extreme, when fear distorts valuation across markets, the holder of cash becomes the final buyer. There is no need for forced selling. There is no need to request additional credit. The investor with liquidity can determine terms rather than accept distressed prices imposed by others. During major crises such as 1973 or 2008, and similar events that will occur again in the future, those who preserved liquidity were able to acquire high-quality assets at deeply discounted valuations. Sometimes at 50 cents on the dollar, they purchased durable businesses, valuable real estate, and leading companies when crowd fear pushed prices far below intrinsic value. This is true leverage. It is not leverage derived from borrowing. It is leverage derived from the desperation of others. While surrounding participants panic, absorb losses, and attempt to preserve what remains by selling their strongest assets at discounted prices, you can act rationally. There is no urgency. There is no noise. You step forward, present a fair price, and execute the transaction. In that moment, the market belongs to those who retain purchasing power. In volatile markets, financial leverage is often promoted as a rapid path to wealth. Yet debt-based leverage can convert you into a victim when the cycle reverses. Liquidity-based leverage operates in the opposite direction. It places you in control. It insures you against collective irrationality. It enables you to strengthen your position precisely when others are weakened. The composite man understands this principle. He does not borrow aggressively at market peaks. He preserves liquidity to accumulate at market bottoms. When you hold cash, you are not merely protecting yourself. You are preparing to shape outcomes at decisive moments. This is not passive waiting. It is active preparation for victory. The disciplined application of this principle is central to capital management. I would rather hold cash and be criticized as outdated or overly cautious than join speculative enthusiasm and disappear when the cycle turns. After decades of observing Wall Street, one reality remains consistent. Those who appear most brilliant during bullish expansions are often the first to vanish during contraction. They dismiss prudence during prosperity. Yet when conditions deteriorate, they urgently seek liquidity and survival. Markets do not reward intellectual superiority or random luck. They reward discipline. Discipline in position management. Discipline in rejecting short-term temptation. Discipline in maintaining liquidity even when others commit all available capital. Each decade, the cycle repeats in a familiar sequence. Rational optimism evolves into blind enthusiasm. Enthusiasm evolves into extreme confidence, under the belief that conditions are permanently different. Finally, reality returns and confidence becomes despair. This is not coincidence. It is the nature of collective behavior, and it is the mechanism through which the composite man transfers assets from the undisciplined to the disciplined. When managing capital for others, particularly retirement savings, lifetime savings of small business owners, or the accumulated resources of middle-class families, you do not have the authority to speculate recklessly. The primary objective is not to maximize short-term returns for public recognition. The primary objective is to minimize permanent capital impairment, the type of loss that can erase years of disciplined accumulation within a single adverse cycle. Once trust is lost, it is far more difficult to restore than financial capital. Within the Wyckoff method, capital management places defense first. Holding cash is not fear. It is humility and responsibility. During speculative expansions, you may appear foolish, while others generate rapid gains and criticize your restraint. Yet when the markdown phase arrives, when those same critics are forced to liquidate high-quality assets at distressed levels to survive, you remain capable of acting and rebuilding. Consider the long horizon. Do you prefer to appear intelligent during a few favorable years, or to achieve durable wealth and security across decades? Discipline does not generate excitement or headlines. However, discipline in liquidity management, discipline in avoiding excessive leverage, and discipline in waiting for genuine opportunity are what enable survival through every cycle and sustained success over time. The composite man never commits all capital impulsively. Survival is half of the contest. The other half is seizing opportunity when others are exhausted. Dear friends in the United States, we have traveled together through an important journey. We have dismantled the myth that cash is trash. We have examined real-world lessons about the danger of arrogance. We have explored the strength of liquidity during panic. We have understood the role of cash as weapon insurance and true leverage when the market shifts direction. All of this revolves around a central truth of the Wyckoff method. You cannot predict with precision when the storm will end, when the markdown phase will conclude, and a new accumulation phase will begin. Yet, you can prepare a dry bucket in advance to collect value when opportunity falls. Cash represents that readiness. It provides clarity of thought when others lose direction. It is a competitive advantage that never expires. Markets may change instruments, technology, and narratives. The law of supply and demand does not change. Those who maintain liquidity retain control. Those who exhaust cash become victims of insufficient preparation. Today, I urge you to act with discipline. Build your own fortress. Maintain surplus liquidity. Avoid excessive leverage that can transform you into prey when the cycle reverses. Cultivate patience. so that you wait for genuine opportunity rather than chase minor advances. Do not allow favorable market years to drain your cash simply because you fear missing incremental gains. When the music stops, when panic spreads and value is liquidated indiscriminately, you will hold the large bucket. You will quietly acquire high-quality assets at fair value instead of standing immobilized by regret and theory. The Wyckoff philosophy I leave with you is simple and profound. Survival is half of the contest. The other half is capitalizing on opportunity when others are exhausted. Cash is not trash unless you lack it when it is needed most. It is long-term discipline transformed into peace of mind. It is the key to becoming the participant who writes the final check at decisive moments. Apply these principles to your portfolio beginning today. Not to become wealthy quickly, but to become wealthy sustainably, securely, and with genuine independence. Markets will continue to test every participant. If you preserve liquidity, maintain discipline, and remain composed, you will not merely endure, you will prevail. Thank you for your attention. May you always hold a dry bucket when value falls from the sky.